Hey everyone, welcome to a special edition of the Week in Charts 10 surprises from the first half of 2023. I'm your host, Charlie Bilello, and boy, do we have a lot of surprises from that first 6 months of this year. I want to start out with the U.S. economy and the recession that never came. So, back in December 2022, a lot of pessimism out there. I did this poll on Twitter asking people about the economy. 85% said we're either in a recession already or going to be in one in 2023. And they were pointing to things like consumer sentiment. University of Michigan hit a record low in 2022, and we saw 8 consecutive months below 60, something we had never seen before. They were also pointing to the stock market, which was down 18% in 2022. And the stock market tends to be a leading indicator of the economy. So people were saying stocks are going down. There must be problems with the economy. And of course, they were talking about the U.S. yield curve, where we saw the 3-month Treasury bill yield rise above the 10-year Treasury yield. And that's often a harbinger of economic weakness to come, this inversion of the yield curve. Now, what actually transpired in the first 6 months? Well, we have full data now on the first quarter, and the final report we got from real GDP in the US was actually 2% annualized, which was a revision from 1.3% the first time. And so no recession in the first quarter. And if we look at expectations from the Atlanta Fed, which does this real GDP prediction, they're expecting over 2% for the second quarter. So again, there would be no recession for the first half if this expectation comes in at around 2% or even above zero. So what do we have in terms of the economy that's really helping it remain out of a recession? Number one would be the jobs market. And we've seen now 30 consecutive months of jobs growth in the US, a great thing to see. First 6 months of the year, all positive, definitely above expectations in terms of the number of jobs created. And we actually saw the unemployment rate in the US hit a 54-year low during the first half of the year of 3.4% back in April. It ended June a little bit higher at 3.6%, but continued strength in the labor market. Definitely a big surprise for a lot of people, and for now, keeping the US economy out of a recession. Number two, tearing down the wall of worry. And boy, were there a lot of things to worry about at the end of 2022. You had inflation, rising interest rates, the Fed tightening policy, Russia and Ukraine, the war there, and recession fears, of course. And all of these factors have become less worrisome for market participants, and really that wall of worry that persisted throughout of 2022 has been torn down. And if we look at the VIX, we can visualize that, where the VIX a number of times was above 30 in 2022, and we actually saw the VIX close below 13 in the first half of the year. 1291, lowest close since January 2020, so finally back to pre-COVID levels in terms of the volatility of index. Very few people would have predicted that entering the year. And looking at the stock market, strategists for the first time in decades were predicting a down year for stocks. This is very atypical. They usually predict a positive year because the market is often positive 3 out of every 4 years. But entering 2023, we actually saw a Wall Street strategist for the first time in decades predict a down year for stocks. So what actually happened was definitely a surprise. It was actually one of the best first halves of the year that we've seen in history, up 16% on a price basis, more than that on a total return, including dividends. This was the best 124 trading day period since 2019. And before that, you had to go all the way back to 1997. So very good first half of the year, very much unexpected by market participants. Number three, speaking of unexpected, nobody entered the year was saying that this was going to happen. I didn't hear anybody mentioning this, but what we actually saw was not just a run on a bank, but a run on 3 major banks. They were actually the second, third, and fourth largest bank failures in history occurred in a very short period of time. First Republic Bank, Silicon Valley Bank, and Signature Bank all failing. They ended up, the depositors did not get hit in any of these cases. They came up with a plan, and depositors were made whole. So they weren't hit. They were considered a systemic risk. So not a hit to depositors, but for a brief period in markets, the markets reacted obviously negatively to this news, but very quickly recovered. And what really set the market at ease was kind of this stealth QE from the Federal Reserve, where they reversed course. They had been shrinking their balance sheet since last April. They reversed course very quickly, providing a massive amount of liquidity, $392 billion over a 2-week period after Silicon Valley Bank failed. Most of this came in the form of loans issued to banks to give liquidity, to say that they didn't have to go out and sell their money good assets if they were having deposit outflows. The Fed would be there as the lender of last resort, and that really calmed markets, and markets very quickly recovered to post to higher levels than before these failures occurred. Now, interestingly, the Fed by the end of the quarter had reversed all of that extra liquidity and more. So we actually saw the Fed balance sheet down $393 billion over the last 14-week period ending in June. And so market participants, for now, this is not something that people are even talking about, which is pretty incredible given what occurred during that short period of time. And if we look at the NASDAQ 100, up 39% total return, S&P 500 up over 16%, very different picture than the regional banks. So regional banks off of their lows, but still down over 29%. A concern is that perhaps we're going to see more failures, but for now, the S&P 500, NASDAQ 100 very much shrugging this off. And if anyone could have predicted, which they didn't predict, that this was going to happen in terms of these bank failures, they certainly wouldn't have said that the stock market would have done what it did in the first 6 months with the amount of strength with the NASDAQ 100 up 39%, pretty much ignoring the second, third, and fourth largest bank failures. Number 4, higher for longer. What am I talking about here? I'm talking about Federal Reserve and interest rate expectations. And this is a big shift. This is a big surprise, because early in the year, what people were expecting was that the Fed would hike maybe 1-2 more times, but then be done and start cutting rates aggressively in the back half of 2023. And you would see a Fed funds rate below 3% by the end of 2024. And what did the Fed do? Well, they actually have hiked rates to now over 5%, which was not expected. And although they paused at the June meeting, they're now signaling that there are more hikes to come, at least one more in terms of July, and perhaps even another one after that. So market surprise in terms of more hikes that the Fed's already done, and additional hikes that the market wasn't expecting. And here's the real big one, is that market expectations of when the Fed is going to start easing policy have been pushed way back into 2024. So now no rate cut expectations on the table for the back half of 2023. And we have a higher expectation of a terminal rate if we look out to the end of 2024 than market participants were expecting. So a much more hawkish Fed than people were expecting. And the interesting thing here is that the S&P 500 at the end of June, on a total return basis, less than 5% below its prior high from early 2022 when it peaked. So less than 5%, and you have the Fed already hiking rates from 0 to 5% and expected to continue to hike, and the S&P 500 only down 5%. Pretty incredible. Bonds still down 13%, so bonds actually in a worse position than stocks, even with these massive interest rate hikes, which just proves once again that there's no real formula you can come up with in terms of predicting what the stock market will do, given what the Federal Reserve will do. So even though the Fed's hiked now 500 basis points, S&P 500 less than 5% off of its prior high. Number 5, the road back to normal. This is a very good thing. that a lot of people weren't talking about. The fear was that inflation was going to continue to be a big issue in the first half of this year. And what we've seen is just month after month of a decline in the inflation rate, CPI all the way down to 4%. That was in the May reading. The expectation for June is we're going to see a low 3% CPI. That would be the 12th consecutive month of a declining CPI in the US. And if we rewind to last year, last June, it was at 9.1%. That was the highest we've seen since the early 1980s. So much better. I think that people were expecting a big surprise in terms of how quickly it's come back down to 3%. And again, that June CPI report will be released next week in July, and the expectation is we're going to see a huge jump lower down to 3.2%. Now, if we're looking at real-time inflation data from Truflation, they're saying that the actual inflation rate out there is actually even lower, so at 2.3%, not far from the Fed's 2% target. So interesting to see that this was over 11% if we look at last year, all the way down to close to 2%. And a big driver of that has been continued surprises in terms of the supply chain easing. Many of the supply chain metrics are back to pre-COVID levels, which is great things to see. This is a chart showing you of freight rates, which I show all the time, but down 88% from its peak and the lowest level since 2019. So better than early 2020 levels. Incredible to see. And lastly, on the inflation front, this is the most important chart to me in terms of the economy, in terms of prosperity, and we are back in positive territory. I think faster than people expected. It was a long time below zero, 25 consecutive months of negative real wage growth, but finally now we have wages outpacing inflation. So people are feeling good about that. They should be feeling good about that, and hopefully that continues in the back half of the year with wage growth outpacing price increases. Number 6, the housing market resiliency. I didn't see this coming. I don't think many people did. We really underestimated what the lack of supply was going to do to the housing market. So we got it right in terms of activity, but did not get it right in terms of the stalling of the price decline. So what we're seeing here is a chart of the breakdown in mortgage holders by interest rate. And what we have is many mortgage holders have much lower rates than are out there today. The 30-year mortgage rate currently is close to 7%, and most people have a mortgage rate well below that. And what that has led to is just an absolute collapse in supply. People are not selling their homes and giving up those low interest rate mortgage rates, and in many cases they couldn't afford to buy a new home at a higher interest rate at current market rate. So that's really led to a standstill in terms of activity. Redfin said that this was the least number of active listings that they have on record. They have data going back to 2012. And this lack of supply, and even though demand is down, this lack of supply is really leading prices to really stabilize, something that most people didn't see coming. I didn't see coming. We thought that prices would come down more because affordability was so bad heading into the year. Not many people could afford the average home price, but because supply has been so low, we haven't seen huge price declines. If you compare this to the past housing bubble peak, we're less than 2% now off of the highs from last year in terms of national home prices. We look at the Case-Shiller National Home Price Index. During the last housing bubble, we saw prices come down over 25% nationally. Now, how long will this continue? I don't know, but so far, much more resilient housing market than anyone would have expected. You would have expected bigger price declines for sure, simply based on mortgage rates spiking as much as they did and the lack of affordability from buyers. And what this has led to, a very interesting thing, is we've been watching the U.S. home construction ETF, so home builders, and all year long we saw strength in this ETF, and it recovered all of its losses from last year incredibly. And we were asking the question, Well, is this portending perhaps an increase in activity? And what we actually saw with the last housing starts number, well, here comes that increase in activity. Hopefully, this continues now up year over year in terms of new homes being built. Home builder confidence is going up. And the big reason for that is that lack of supply. So if you're looking for a home to buy, you're increasingly likely to be looking at a new home as opposed to a lack of inventory in existing homes. So that's good for home builders. We're seeing those stocks completely recovered. And we need much more supply. So hopefully this housing market activity continues. If you build these homes, they will come to buy it, is what I'd like to say. So one way to to help affordability, increase supply, bring down those prices for people. Another way, obviously, would be for mortgage rates to come down. That hasn't happened so far. So in any case, you want to see more supply. It's simply after the financial crisis, that collapse in housing starts and activity, it did not keep pace with household formation. So there's still a lack of supply in terms of homes, and the more homes that are built in the coming years, the better off we'll be. Number 7, the earnings recovery. So heading into the year, there was an earnings recession in 2022. We thought that would continue. All signs really pointed to that. And what we saw in the first quarter was something very different. Companies very quickly had adjusted in 2022 to higher prices. They got leaner. There was a lot of layoffs. There was a lot publicized in terms of the tech sector. And they actually eked out a profit unexpectedly in that first quarter with a 6% increase in terms of S&P 500 earnings. Sales were actually up 9% year over year. So unexpected, much better than expectations. That earnings were actually higher than a year ago, even with the huge amount of inflation that we saw. So a big driver of this was margins expanding. And we talked about during the year just how incredibly companies reacted to these higher prices very quickly, very swiftly, right-sizing their businesses. And we actually saw a margin expansion in that first quarter. We'll see if this continues. It's certainly not going to be easy for companies going forward. You're likely to see growth slow, but just remarkable that we saw earnings go up over the last year in spite of all the headwinds in terms of rising interest rates being the biggest factor there. Incredible to see corporate profits actually go up. Number 8, again, not something people were talking about. ChatGPT was not on anyone's list heading into the year that I saw, but there was an AI mania following that ChatGPT release and just how it really took hold of the market and really led to a resurgence of big tech in terms of a major comeback after the losses last year. And if you listen to the earnings calls from the first quarter of 2023, you're going to hear all about AI and much more than you were hearing about it last year. Most companies last year, very few mentions of it. This year, that's all anyone could talk about. And the reason for that is this is going to be a revolutionary technology. The other reason is that companies were being rewarded in terms of their share prices the more involvement they had with this AI revolution. Number 1 in that category would be, of course, NVIDIA, which is going to be the big supplier, big market share of this boom, over 90% market share in terms of the number of chips supplying AI for now. And NVIDIA's best performing stock in the S&P 500 in the first half of the year, up 189%. You're seeing many other tech companies benefiting from this on this list as well, Meta being one of them. AMD is on here, many other semiconductor stocks, really a rising tide that lifted many boats when it came to the AI boom. And what we've seen from NVIDIA is something pretty remarkable. Had a sizable sell-off last year, down over 60% off of its high in 2021, and just came roaring back on this belief that there's going to be a huge boom. We saw it already in the first quarter, but the expectation is we're going to see just huge acceleration in growth to come. And you see 62% annualized return for NVIDIA shareholders over the last 10 years, something you rarely see for a company this size. It actually hit a $1 trillion market cap this first half of the year as well. The big question, as we've talked about, is how much is too much in terms of valuation, and the expectations are extremely high. Nvidia price to sales ratio going up to 40 times, price to earnings, you could just really throw that out because the market's expecting so much in terms of earnings, but over 200 times earnings. And it lifted all of big tech back up in terms of its valuations. All of these big companies now trading at high multiples once again, something very few people were predicting. People were saying interest rates are going to go up. If the Fed keeps raising rates, you're going to see these multiples continue to compress. That simply did not happen. Fed's hiked rates 3 more times this year, expected to continue to hike. And we've seen multiple expansion this year on this euphoria. You might call it a mania in terms of AI. And if we look at what I've termed the enormous 8, the first half was unbelievable in terms of Nvidia, Meta, Tesla, Amazon, Apple, Netflix, Microsoft, Google, all having tremendous first halves of the year. So the demise of big tech that was written about in 2022 was a little bit premature with these run-ups. Apple, of course, hitting a new all-time high. The average stock not faring nearly as well as big tech. You had the S&P equal weight up 7%, small caps up 6%. But big tech, particularly stocks like Apple, leading the market once again. Apple hitting that, closing at that $3 trillion market cap for the first time. And if we look at Apple's share of the S&P 500, 7.6%. That's the highest for any individual company in the S&P 500, highest weighting with data going back to 1980. Well exceeding IBM, which was in the 1980s, Microsoft, ExxonMobil. These are some of the other companies in different periods for the market that held the highest weight. Apple is ahead of all of those. And if we look at Apple and Microsoft together, 14.4% weight in the S&P. That's the highest for any two companies. So big tech concentration, the resurgence of growth, all things that people were not predicting heading into 2023. Number 9, the travel boom. So we saw retail sales, and this was expected, certainly expected by me, retail sales cool off on a year-over-year basis, down up less than 1%. And if we adjust for inflation, it was 7 straight monthly declines on a year-over-year basis for retail sales. So the consumer is spending less, but their habits have shifted. What they're spending on has shifted, much less in the goods area and much more on experiences and particularly travel. And if we look at those TSA travel numbers that I've been looking at for the past few years, waiting for this point to happen, we're finally there. 2.65 million travelers in the U.S. per day on air travel. That is the highest 7-day period we've seen. You have to go back pre-2019 because it never even happened in 2019. So we're at new all-time highs in terms of air travel in the U.S. People did not expect this to happen back in 2020 this soon. They were talking about it's going to take a decade to get back there. We're already there. It's a great sign. People are traveling again by air, not just air, but also cruise lines, which definitely no one was expecting, had a record first 6 months of the year. This is expected to be the busiest summer ever for cruise lines. They're talking about ships being more than 100% occupied. And we have Las Vegas conventions all of a sudden back higher than 2019 levels. Hotel indices back as well above 2019 levels. So all these things pointing to a travel boom for the remainder of the summer. And we've seen these factors reflected in share prices with Royal Caribbean, Carnival Cruises, both up over 100% in the first half of the year. And you have Delta, United, other airlines up over 40%. So well outpacing the broad market in terms of these returns. Number 10, this can't be overstated. It's really a triumph of the optimist if we look at the first half of 2023. If you look at all of the negativity and the reasons to be worried coming into this year, the list was a mile long. But if you were optimistic, if you're finding the silver lining in what the market had to offer, from last year. We talked about the best thing that could happen for market participants was higher interest rates, higher yields, higher prospective returns. If you took that optimistic attitude, so far you've been rewarded. It's really been the polar opposite of 2022 in so many ways. Almost every major asset class higher in the first 6 months of this year, the exception being commodities, which was the leading asset class and one of the only things to do well in 2022, actually down this year. And that's viewed as a positive because that is largely a reflection of lower inflation. But everything else higher, from bonds to high yield bonds, regular bonds, investment grade bonds, mid caps, small caps, international stocks, emerging market stocks, S&P, growth, value, NASDAQ 100, and crypto, everything higher on the year so far. And if you're optimistic and you take a long-term view as an investor, well, you've been rewarded with sticking with your portfolio after 2022. Now, the question, of course, is what's going to happen in the second half of the year? And these are the questions I often get. Where will the S&P 500 end the year? What about the 10-year yield? Where is crude oil headed? Is gold or Bitcoin a better investment today? How many more times is the Fed going to hike rates? Is inflation going to rise again, or is it going to go back down and stay below 2%? When will the next recession begin? I don't have the answer, unfortunately, to any of these questions. Nobody does. The future is unknown. As Lao Tzu once said, those who have knowledge don't predict. Those who do predict don't have knowledge. So as an investor, you don't have to predict to do well in markets. You have to take a long-term outlook. You have to control your emotions. You have to invest based on probabilities, never certainties. And so throw predictions out the window. They're all going to be wrong, most likely. And even if they're right, that was probably more luck than skill. So what am I expecting for the second half of the year? I have one prediction only, and that's you're going to see many more surprises ahead. That is the nature of markets. It's constantly surprising us. And so we'll be doing this again in early 2024, talking about the many surprises in the back half of this year. So with that, we'll end it there. Have a great summer, everyone. Thanks for joining. If you like the content, subscribe to the channel, and we'll see you next time on the Week in Charts.